A 1.5 trillion wall of debt is looming for US commercial properties. Now, when you read a headline like that, it's Game of Thrones level scary stuff. Does it mean an apocalyptic event is coming for commercial real estate? Are we set for a tidal wave of foreclosures, followed by a fire sale of properties by lenders who have no use for them? And with banks holding over half of agency-backed CMBS, there's also systemic financial risk to think about. With so much attention and anxiety around CRE these past few months, we thought it'd be good to look at this so-called wall of maturities. Let's break it down. Simply put, it means that hundreds of billions of dollars worth of commercial mortgages are scheduled to come due every year for the next 3 years, i.e. you got to pay the principal amount back. Borrowers who took those loans, if they're not selling their properties, are most likely going to have to go and refinance. But the environment in which they're going to be looking for their money is very, very, very different. First of all, interest rates are much higher than they were when the initial loan deal was struck. So let's say you got your money at 3 or 4% in the good old days, you're now looking at 7 or 8% for your loan, which means your monthly payments will be a lot higher. Then there's the perception that your properties are nowhere near as valuable as they were before. Morgan Stanley estimates office and retail property valuations could be down as much as 40% over the next few years, which would make defaults a lot more likely. And if a lender does agree to give you money, they're going to do so at a much lower loan to value. So you're likely left with 3 options, all of them not so great. Number 1, you might be forced to put even more skin in the game in the form of equity in order to secure this loan. This is known as a cash-in refinancing. You'd likely do this if you think the property still has a lot of room to run, either in terms of getting your promote or your ability to boost NOI at the building, or maybe the potential to sell it down the road at a higher price. This is essentially you renewing your vows to the property. Number 2, you bring in another investor to add to the pot. At this point, they'd likely have a lot more negotiating power than you, so the deal is going to be structured in their favor. So you might take this option if you still see an upside in the fees that you can collect from the deal. And then there's the nuclear option, which is walk away, hand the keys over to your lender, and sayonara, you're done. You do this when you think there's not enough upside left in the property to justify putting more money in, or you just can't find the money to put in. And again, the environment for your product is really important. You're going to hear a lot, and you've already heard quite a bit about office landlords and brokers speaking of the office as kind of the centerpiece for collaboration, etc., etc. They're going to invoke everything from innovation to community to even patriotic and civic duty. This has already happened. Yet, this is the reality. Offices are often half empty. On certain days, they're a ghost town, and they're no longer at the centerpiece of the American economy the way they were a couple of years ago. So if you lose that prime position in the workplace, something's got to give. This is a pretty complex topic, and for some, it's a scary one. So what else would you like to know? Drop us a line in the comments below, and be sure to follow The Real Deal for more Paydirt breakdowns.